Hey everyone, and welcome to AI Explains ICT. Today we're jumping right into some really powerful stuff from the core content, specifically Month 6, Episode 8. All right, just a quick heads up before we get started. This video is going to be packed with charts and some pretty detailed analysis, so you'll definitely want to have a notepad handy. And seriously, don't be afraid to hit that pause button to really let things sink in. Trust me on this, it's going to be worth it. Okay, let's get into it. ICT famously laid out what could be considered a game-changing setup. And today, we're breaking down that entire method for crafting the high-probability swing trade. Now, this isn't about throwing darts at a board. It's a complete systematic framework that takes you from the initial idea all the way through to execution. So here's the game plan for today. We're going to start with the biggest picture possible, seasonal tendencies, and then we'll systematically narrow our focus. We'll look at market conditions, run through specific checklists for both bullish and bearish trades, and then we'll see how it all comes together in a real-world example, from the analysis right down to managing the live trade. Think of it like a giant funnel designed to filter out all the noise and leave you with only the absolute best opportunities.
All right, let's build this from the ground up. Starting with the absolute foundation, understanding the seasonal flow of the market. According to ICT, this is the first step and it is completely non-negotiable.
So that begs the question, where does every single high probability analysis begin? Well, ICT's answer is surprisingly simple, but incredibly powerful. It all starts with what's called a seasonal tendency. And really, this is just a fancy way of saying it's a pattern in price that has proven, historically, to repeat itself at a specific time of the year, year in and year out. And the reason this is our starting point is huge. It immediately puts historical probability on our side before we've even looked at a single candlestick. And take a look at this 40-year seasonal chart for gold. I mean, this shows the concept perfectly. Just look at that powerful, consistent rally that tends to kick off every single year, right around December, and running through February. See, that isn't just random market noise. That's a real statistical edge that we can build our entire analysis on. So this brings us to our very first checkpoint in the whole system, and it's a simple yes or no question. Is there a seasonal tendency to be a buyer or a seller right now? If the answer is yes, awesome, you have the green light to proceed. But if it's no, according to ICT, you stop. Right there. You don't hunt for a swing trade. This discipline, by itself, is going to filter out countless low-probability setups that would otherwise waste your time and money. Okay, so once we've confirmed we have that seasonal wind at our back, the next step is to zoom out a bit and gauge the overall market conditions. We need to see if the environment is even right for a big, sweeping swing move. And ICT breaks this down into a really simple two-part check. First, are interest rates and/or currencies trending? And second, are commodities and/or stocks trending? That's it. And these charts here show exactly what we're looking for. Over on the left, you can see T-bonds are in a clear, defined downtrend. And on the right, the dollar index is in a clear uptrend. What you don't see is choppy, sideways, confusing price action. Nope. This is directional, trending movement. And that's exactly the kind of environment we need to support a trade that could last for weeks or even months. Now here's our really important detail. You don't need all four of these major asset classes to be trending at once. You just need one from each group. So in this example, the CRB commodity index on the left, it's basically flat, right? Just consolidating. But that's totally okay because its partner, the stock market on the right, is in a very strong, clear uptrend. So since we have a trend in stocks and we already saw trends in bonds and the dollar, our conditions are met. We can move forward. All right, so our seasonal box is checked, our market conditions box is checked. Now we can finally zoom in and start building a specific case for a trade. We're going to start with the checklist for a bullish setup, looking at something like a foreign currency or a metal like gold. And the very first filter at this stage involves looking at what the quote-unquote smart money is doing. So we turn to the Commitment of Traders report, or the COT report, and we ask one simple question. Are the commercials buying? This slide shows you exactly how to find that answer. We're looking at that red line, which represents the commercials' net positions. Now, notice how in late 2016, that red line started to move up really sharply. And here's the key. Even though they were still net short overall, relative to their own 12-month range, they were aggressively cutting their shorts, which is, for all intents and purposes, a form of buying. This is a huge signal that they're anticipating higher prices. Next up, we bring in some intermarket analysis. It's just common sense, right? If you're expecting a foreign currency or a metal like gold to go up, What should the US dollar be doing? Well, it should be showing signs of weakness. And this right here, this is one of the most powerful confirmations you can possibly find. It's called smart money technique, or SMT divergence. Now, look really closely at these two charts. On the right, the dollar index is making a distinct higher high. But look what happens at the exact same time. Gold, on the left, fails to make a lower low. Think about that. The dollar is showing strength, but gold is flat out refusing to go down with it. That is a massive, massive clue that there's underlying strength in gold. And finally, we have two quick confirmation checks to round things out. First, are commodities in general rallying? And second, has open interest, which is just the number of active contracts, has it dropped by a decent amount, say 10 to 15%? A drop like that really confirms that commercials are actively covering their shorts. If we get a yes to all of these points, we finally get the green light to dive into our charts and actually frame the trade. Okay, so that's the bullish side. But what about a bearish setup? Well, the beauty of this system is that the logic is exactly the same. It's just flipped completely upside down. It really is a perfect mirror image of the bullish checklist. And this little table here just makes it crystal clear. For a bearish trade, we'd want to see the commercials selling or adding to their shorts. We'd want the dollar index showing strength, maybe with a bullish SMT. We'd want commodities dropping and open interest rising as those new shorts are being put on. See? It's the exact opposite set of conditions, but it's the same systematic logic that drives the whole thing. Okay, this is my favorite part. This is where all the theory comes together and hits the real world. Let's actually walk through that late 2016 gold trade and see how this entire analytical framework was applied, step by step, to find, frame, and execute a really high probability swing trade. So, with all our conditions met, the top-down analysis can finally begin. The process is simple. We identify key price levels, what ICT calls PD arrays, which are things like order blocks or fair value gaps. And we find them on the monthly, weekly, and daily charts. Then we take all of those important levels and we just transpose them onto a single 4-hour chart. We're looking for clusters or a confluence of levels that create these really powerful zones of support or resistance. And for our gold trade example, this exact process pinpointed a major monthly bullish order block, a key institutional support level right around the 1142 price point. This isn't just a random line on a chart. This gives us a very specific, very high probability zone to start looking for our long entry. But knowing where to get in is only half the battle, right? You have to know where you're going. And that same top-down analysis identified a key area of resistance, a weekly premium array, way up near the 1260 level. So now, just like that, we have the entire trade completely framed. We have a potential entry around 1142 and a logical target around 1260. This defines our entire potential trade range. And ICT's model adds another layer of mechanical precision that I think is brilliant. The type of price level you're trading from actually tells you what type of order to use. So for certain levels, like a breaker or a fair value gap, the model suggests using a buy-stop order, so you're entering with momentum. But for an order block, like in our gold example, it calls for a buy-limit order, where you're aiming to get filled as price dips down into that key support zone. All right, getting into the trade is one thing, but managing it correctly once you're live, that's what really separates the consistently profitable traders from everyone else. And the great thing is, the system doesn't just end at the entry. It gives you a clear set of rules for managing the position all the way until it's closed. So, here are the core management rules. First, you take a small piece of the profit off the table early, maybe 20 to 30%, once you're about a quarter of the way to your final target. Now, this is crucial. You only move your stop loss to break even after you've banked that first profit. Then, you have to be mentally prepared for a stop run after the halfway point, the equilibrium, is hit. We'll look at that in a sec. And finally, you take the bulk of your position off, like 75 or 80%, at that final objective. This chart just lays out the entire trade plan so beautifully. You can see our entry zone down near 1142, you can see our final objective way up at 1260, and right there in the middle, you have that critical 1200 level, which marks the 50% or equilibrium point of that entire expected move. Okay, now zoom in on this slide, because this is so important. Look at what happens right after price breaks through that 1200 equilibrium level. See that sharp, aggressive pullback? That's a stop run. It's designed to shake out traders who trailed their stop loss up too tightly and too soon. According to ICT, this is a completely normal and expected feature of price action. The system tells you to anticipate this, which is exactly why you don't move your stop too early. It keeps you in the trade. And this quote from ICT it sums it all up perfectly. The system forces you to wait. Once you get the conditions, you know how to trade accordingly. You know when to take a stop loss and move it higher, and when to leave it alone. See, this isn't just a random collection of indicators, it's a complete logic framework. It forces you to be patient by making you wait for all the conditions to line up. And once they do, it gives you specific rules for what to do next, when to protect your position, and just as importantly, when to just sit on your hands and let the trade do its thing. So I'll just leave you with this one question to think about. What do you think you could achieve in your own trading if you had a complete rule-based system that forces that kind of patience and gives you the discipline to follow a plan from start to finish? If you found this breakdown valuable, it would mean a lot if you'd like this video and subscribe to the channel for more of these deep dives. And if you have any questions at all, just drop them in the comments below. A real human will get back to you. Until the next one, safe trading.